There's an age-old question of will there be a market crash, and the simple answer to that is yes. It's undeniable the market moves up, but at the same time, as enough time passes, it will also decline. It's an inevitable event. Things don't go up forever, from bull market to bear market. You can look at this from visual capitalists to get a clear example that things don't go a certain direction forever. We can look at the chart now. We can see this is about the stock market cycle from 1962, followed by every recession. And generally, with a recession, the market goes down because people are losing jobs and are saving money instead of investing. So, this is a very skeptical time for people. And you can see every time there's a bear market, there's a bull market, bear market, bull market. The duration of each market is different, but pretty much everything goes up, but it also has to come down. And every time it goes down, it also has to come back up. Corrections happen given enough time. It's my personal belief we will have a market crash possibly as soon as after the elections or going into early 2025. Not to get political, but during an election year, whoever's in charge is going to want to win again. So it's not like they're going to let the market crash. And in this case, it's Joe Biden and his administration. If you're currently in power and it's an election year, the dumbest thing you can do is let the economy crash before voting season. But at the same time, I cannot see the future, so I cannot be certain. It's just a belief. It's a bearish opinion, but as many bearish people there are out there about the investment markets currently, there's an equal number of bullish people that say everything will keep going up.
About 15 or 18 months ago, and we did a live stream where I very emphatically said the real estate market is not going to crash, values are not going to tank, and here's how I know that. And I went through several data points on the air.
And this is the same with the real estate market also. If you are a bull, then I hope you don't disregard my opinion and watch the video to understand where I'm coming from with my thoughts. They say it's a booming market currently, but please understand a booming market may be deceiving. You can say we are doing good right now, but if it's attributed to deficit spending or wow, we got a great jobs report, but if the reality is we have a lot of people getting part-time jobs due to inflation, then the reality is we are doing bad. If anything, it shows a declining buying power and the American economy on life support. We can look at our national debt, for example, and you can see the national debt. A deficit occurs when the federal government spending exceeds its revenues, and the revenue is our tax dollars. So they basically burnt through our tax dollars, and currently for the year, they are basically over $1 trillion in a deficit. This is money that we don't have, and this is money that the future generations will have to pay for what's happening currently. We can go over to CNBC real quick, and we can see the US national debt is rising by $1 trillion about every 100 days. Guys, this is really bad for our buying power, and it's really bad for just the economy in general. We can look down, for example. Right here, we can see from October 22 to 23 in about April, the deficit was going up at a decent pace, I guess you can say, but then all of a sudden it accelerated real fast. And, you know, this is just really bad for us. But think about that. We're currently in $34 trillion in debt, and we went up $1 trillion in 100 days. You just cannot say this is sustainable in a healthy economy. If you are a bear, well, then give me your thoughts below on if you are on the same page as I am. The intent of the video is not on when a crash might happen, as it's impossible to guess, but rather I want you to be prepared for anything that comes in the future. If you're a bull, for example, you should be informed on both sides so you don't end up in a situation where you got caught with your pants down, basically. Underwater mortgage or stocks taking years to recover, for example. At the very least, guys, if you do watch this video, you get to say that at least you saw the information before stuff goes bad, if stuff goes bad. But again, given enough time, things do go bad. So these are tips on how to navigate the market. Be prepared rather than get caught off guard is the best thing you can do. And I ask, if you know any young teens, high schoolers, or young adults, share it to them. This next 1 year, we might see a critical shift in the economy, and they'd obviously be living through it. I was only a kid during 2008, so it didn't bother me really, but if you're older, you should watch what happens, so in the future, you might know what it's like in a time of possible turmoil. and know how to navigate or even take advantage of the opportunities then. Because think about it, guys, if you were alive during 2008, if you weren't financially literate or you didn't have these tools in your toolbox, then you possibly could have dropped to rock bottom. But if you were someone that's savvy, someone that saved money and were intelligent with finances, then you possibly took advantage of the market. And when everything went on sale, for example, during 2008, 2009, think about all the people that bought stocks and all the people that bought real estate for a 25% plus discount. Those people are probably really wealthy right now. They took advantage of a time of turmoil and made it into gold, basically. So, step number one, emergency fund. Everyone needs an emergency fund. It does not matter if you have a bunch of assets, you need capital at the bank because stocks or other assets might not be as liquid, especially in a time of turmoil. If you want to sell something fast, then you will probably have to sell things at a discount, which is the last thing you want to do. The best thing to do is a widely known concept, and it's to have 3 to 6 months worth of expenses inside your bank account, and highly preferred inside a high yield savings account, so at least you're making money and beating inflation, as opposed to a normal bank account which gives negligible APY on your money. Step number 2, debt. Most Americans have debt, but in a time of prosperity, the best thing you can do is knock down your debt. Unless it's a mortgage, because depending on the interest rate, you might be better off investing the difference. But this is more for money savvy people. If you have multiple debts, then it's best to talk to a financial advisor or professional to see what strategies you can use to efficiently clear the debt. In a time of possible turmoil, like 2008 for example, losing your job was bad, but you know what's worse? Losing your job and having monthly debt payments that you end up defaulting on, because now your credit is destroyed, and if you have a car loan or a house loan, then you might get repoed or foreclosed on. Step number 3, live below your means. As I steal this quote from someone, a rich person makes $1 and spends 99 cents. But no, for real, if you don't have any disposable income or income that you can stash at the bank, find out why and fix it. People have needs and wants. If you're eating out or buying nice shoes, then this is a want. Cut back and stash it in the bank instead. You never want to use a credit card or take out loans for wants, because it's digging yourself into a hole. Think about it. You're spending money on a pair of shoes on a credit card because you don't have the money to buy the shoes, meaning you can't afford them in the first place. Those shoes are something that you want, it's not something that you need. So don't go into debt for a stupid reason. If you really want that want or that pair of shoes, then figure out how you can get some excess income so you can buy it with cash. You should always have excess money after paying all your needs, and if not, make it happen no matter what. Those 3 steps were the basics everyone should be working towards at a minimal. Now here are 3 tips for investors. Step number 1, invest for the long term. Most short-term traders lose to the market, so why take these low odds in the first place? The odds to become a successful trader is worse than a coin flip at the casino, so you're pretty much gambling. Do the proven method instead, which is proven by data, which is investing pretty much in the entire stock market over the long term. And this would yield around 7 to 10% on your money yearly. Again, guys, if you jump into the stock market and you jump out and make quick trades, then you're probably going to lose your money. You can look over the history of investing in the stock market, and pretty much the people that win are generally the people that have invested over 10, 20, 30, 40 years. Because if you try to time the market and if you miss the best trading days of whatever time period you're using, so in a 10-year span, if you miss a couple of the best trading days, then you're pretty much gonna lose if you were benchmarking against the whole stock market, assuming you were investing over time. Step number 2, diversification. Guys, everyone needs to understand diversification is key. If you are older and bought the golden child stocks decades ago, majority of these companies are gone now. People thought Sears was gonna be a Goliath, and to be honest, it was, but this was in the past. Fast forward and now it's either on life support or it shut down its doors now. You can diversify in stocks by buying market indexes that track specific categories of stocks. Some may track the entire stock market, some might track stocks only on the NASDAQ 100, some might track dividend stocks only, for example. Some are for growth. So there's a lot of indexes for things, but pretty much the idea is if you buy an index, or something that is diversified, then if one company goes underwater, then at least inside that index, there's not just one company, but there's numerous companies, so you should be safe. The other way you can diversify is by buying multiple asset classes. An example would be saving cash on the sideline or buying stocks. Some people buy real estate, some people buy hard metals like gold, but it's all dependent on what you believe and what you want. Everyone knows when inflation goes up, for example, then the price of gold also goes up, but when things start crashing, gold might hold its value better than, stocks that are dropping like a falling knife. Generally, when one market goes down, then people want to make money in a different market. So if the stock market starts crashing, people might pull money out and invest into real estate, for example. And so this is why you want assets in different classes. If we do go into a recession, then a big thing after a lot of due diligence is just to buy in, guys. Famous quotes everyone knows: be fearful when others are greedy and be greedy when others are fearful. In a time of turmoil, things will crash in price, and this is the go time to buy assets at discounts. Long-term investors see crash prices of assets as a discount rather than the skies falling. Again, guys, in 2008, when everything went down in price, people that had money on the sidelines are probably millionaires now because they bought a couple assets back then and they held it in the long term. The key is they held it for all these years. They didn't sell it after a couple years. Alright guys, in conclusion, these are the 3 steps for all people and 3 steps for all investors to hopefully use as pillars as they navigate the market. Once more, I feel this video is super informative and can pretty much apply to all people. If you made it this far, then please push my videos to anyone willing to learn more about personal finance. Also like and subscribe.